Hi students, how are you? Can you hear me? Students, can you hear me? Okay. Hi, how are you? Are you fine? Okay. I'm your tutor for SBR. My name is Abu Bakr, and I would be teaching you this paper of strategic business reporting. So first of all, let's have an introduction of this paper, which we are going to learn today. The paper SBR. Okay. Okay, if we discuss the journey of this paper at a fundamental level, if we discuss the fundamental level, of ACCA, you have studied F3, known as financial accounting. At FD level, it is also known as FD level. In some region, it is also known as FIA level. After that, at a skill level, of ACCA, we have a paper known as financial reporting, previously known as F7 as well. Financial reporting and F7 paper you have studied after F3. In F7 level, we have studied various accounting standards, almost at 20 accounting standard we have studied. IAS 16, 38, IAS 40, investment property, IAS 36, impairment, some part of the lease, IFRS 9, IAS 32, IAS 41, IFRS 13, IFRS 15, IFRS 3, IAS 27, IFRS 10. The various accounting standard we have studied at FR level or at F7 level. Now we are at a professional stage. And now you are in a final stage of ACCA, and at this level we are going to study final paper of reporting that is known as Strategic Business Reporting, SBR. So SBR, F7 is the base of SBR and F3 is the base of FR. So that is a whole journey of your paper which we are going to study. In SBR also we will study the accounting standards, those accounting standards which we have studied at F3 or at F7 level, and plus the new accounting standard as well. But if I give you a detail and you will look at the course plan as well, almost 40 plus accounting standards we have in our exam of SBR, which we need to prepare, and along with the other subject area as well. So it is a huge paper. It is a very big paper. It is a final stage paper of ACCA, and it is a final paper of your reporting. After that, you are not going to study any paper of reporting in ACCA. Not only in ACCA, but SBR is considered a full-fledged paper, a final reporting paper at various levels in various accounting bodies, okay, with a different name. But this is a final paper of reporting, financial reporting in ACCA. So you can sense the seriousness of this paper, SBR, Strategic Business Reporting. But one more thing, after studying the SBR, the journey will not stop here. We have another paper which is known as Advanced Audit and Assurance. Advanced Audit and Assurance. It is also a final papers of ACCA, optional papers of ACCA. In this AAA paper, I can roughly estimate that at least 25% of your marks, 25% of marks in AAA will based directly or indirectly on SBR, Strategic Business Reporting, because there will be a question on accounting standard in Advanced Audit and Assurance, and we are going to study all accounting standard in SBR. So SBR is very useful at AAA level as well. So that's why it is recommended that before you attempt the AAA, you must study SBR paper, Strategic Business Reporting, before attempting the AAA. And the reason is that at least 20-25% of your exam will be dependent on SBR in AAA paper. So this is the importance of your exam. Now, SBR and F7 are the paper which are related to each other in financial reporting sense. But let me tell you one thing, that the testing, the method of testing of FR and SBR is different. The knowledge is same. The knowledge is same. The number of topics will be same in FR and in SBR, but the way the topic will be tested, the examination style would be quite different in SBR from SBR level. Now, for example, first of all, at FR level, you have OT question, OT case studies, multiple choice question, filling the blanks, and such type of a question. And in MCQs, we also have the number of questions which are dependent on, which are related to numeric based question, which are normally called numeric based question, calculation based question. And at section C level, we have requirement to prepare consolidated financial position, consolidated profit and loss account, or conduct the ratio analysis, or to prepare a financial statement of individual financial statement. So at FR level, the mostly marks are dependent on calculation. That was a calculation based paper. Majority of the marks at FR were calculation based. But at SBR level, the testing will be different. In SBR, the questions answer will be given in descriptive format. We will discuss the given case study. There will be an accounting issue, case study on accounting issue, and we have to discuss. That accounting issue in our answer. For example, if I give an example from IFRS 9, financial assets, we know that equity investments by default classified at fair value through profit and loss account, unless the management has designated those investment on initial recognition at fair value through other comprehensive income to avoid the accounting mismatch. They might give you a case study in which the management have chosen the alternative model, fair value through other comprehensive income, and we need to discuss whether that financial asset, that equity investment can be designated at fair value through OCI, yes or no, and we need to discuss the reasons of our conclusion given in the answer. So that will be more descriptive type paper. SBR, the knowledge is same, but nature of paper is same, but the examination style will be totally different from FR level. Okay, so that would be a difference between FR and SBR. The exam in which the examiner is going to check the knowledge of the candidate in the exam. That would be a bit different from FR. Otherwise, the nature, the knowledge of FR and SBR will remain the same because both papers are relating to financial reporting. Now, the paper will be, as you know, it will be a computer-based exam. It will be a computer-based exam. SBR will be a computer-based exams, CB exam, but it doesn't mean that there will be you can say there will be multiple choice question. It is not such type of a question. There will be no multiple choice question. There will be no OT question. But paper still are computer based. Now, in which form computer based? Because basically there will be a case studies will be given. And we need to answer the question using spreadsheet, or Word, MS Word, Office Word, or both. Okay, so the question, there will be a detailed question. We have to give a detailed answer, but this will be, the answer will be given using the spreadsheet or Word format tools given in the exam. Okay, so that would be the meaning of the computer-based exam in SBR. I will show you the platform as well on which the exam will be conducted, on which the exam will be done. But before that, we will discuss the exam pattern first of all. Then we will discuss the course plan, the topics which we are going to learn in this paper of SBR, Strategic Business Reporting. And after that, we will look at we will take a brief tour of the exam platform on which your exam is going to be conducted. So, if we discuss the exam structure, dear students, your exam will be consist of two parts, part A, and the second one will be a part B. So your exam will be consist of two parts, part A and part B. Now, if we discuss the part A, in part A, the question 1 will be of 30 marks. First question will be of 30 marks, and this first question will be from group accounts plus accounting issue. Accounting issue mean the accounting standards other than the group accounts, consolidated financial statement. So the first question will be on group accounts plus accounting issue. Accounting issue mean there might be a case study relating to financial instrument, which is related to parent company accounting. There might be a question on discontinued operation or asset held for sale, or on provision IAS 37 or IAS 36. Okay, so accounting, group accounts, and any accounting issue can be tested in a question number 1, and the total 30 marks will be available for the students here. Then we have a question number 2. It will be consist of 20 marks. But in this question, again, there will be an accounting issue. Any case study, on accounting standard, maybe on IAS 37. I'm just giving an example. Maybe on lease, maybe on revenue, IFRS 15, maybe on financial instruments, maybe on any accounting standard. There might be an accounting issue, and then plus ethical implication. Because it will be a combo of accounting issue and ethical issue. For example, there will be an accounting issue that the manager is has been forced, is intimidated by the CFO, that a specific provision should be made, despite they know that the creation of the provision in the financial statement would violate the IAS 37 rules and guidance relating to provision recognition, but just to ensure their personal interest or their personal benefits, the CFO is intimidating the manager to record a provision. So first of all, we need to discuss that whether that provision can be recognized or not, and then there will be a requirement which was basically focusing on the ethical dilemma involved in that case study. Okay, and there will be 20 marks in the question related to the question number 2, and we have total 50 marks in a part A, 30 marks in a part B, and question number 1, question A, and 20 marks in a question number 2. Similarly, then we have a part B. In a part B, we have question number 3, and it will be 25 marks. And similarly, question number 4, it will also have a 25 marks. So the 50 marks would be available here. And in both question number 3 and question number 4, there will be case studies. There will be case study relating to accounting problem, accounting issues, accounting standards in both question. Okay. Plus, there will be maybe a requirement on framework or any current issue or any other specific area other than accounting standard. But the mostly the question in a question number 3 and question number 4, the case studies in a question number 3 and question number 4 would be covering the accounting standard, because we need to cover at least 40 plus accounting standards at SBR level. Okay, so if I summarize, so that we have 100 marks, and if I give you a summary, an estimate, as per my experience, that out of 100, 90% marks would based on directly or indirectly purely on the knowledge of accounting standards, and 10 or less than 10 marks would be available for other issues, maybe on conceptual framework or any current issue, or any for example, there is a topic on integrated reporting, alternative performance measurement, or you can say corporate social responsibility, you can framework or current issue. Such topics can be tested up to 10, maximum up to, I'm giving a maximum up to 10 marks, and 90% of the marks would be dependent on your knowledge of your accounting standard and the skill of application of their knowledge on your given case study. Okay, and one more mark. We have total 100 marks, but out of 100 marks, 20 marks will be available only for your professional skills. That means 80 marks are available for your knowledge and 20 marks are available for your professional skills, because now in ACCA, for every professional paper, there are 20 professional marks. There are 20 professional marks available, that how you have attempted the question, the way you are giving the answer, the terminologies you are using, the practicality you are sense you are using in your question, in your answer relating to given case study. That would be available all purely for those things. And those marks are 20% of your exam. So out of 120 marks would be available for your professional. There are known as professional marks, and 80% marks would be available for your knowledge. So keep this thing in mind as well, that now the 20 professional marks will also be available in your exam. Previously, they are available only for AFM or AAA paper or ATX, but now they are available for SBR and SBL as well. Previously, they are only available for SBR, sorry, they were available in SBL only 20 marks, but slowly they have increased, and now those 20 per marks are available in all professional papers, So that was your paper structure, your exam structure, that which will be available for you in a June attempt. Okay. Any question regarding this? Okay. So now that is your lecture plan. It is your lecture plan. And it is an budgeted plan. It is a budget. It is just a plan. It is an estimated lectures are we have provided, number of lecture provided, but the number of lecture can be increased as per the scenario as well. It depends that how we are taking the topics in the class, how speedily we are working. That would be dependent on that. But as per on the basis of my experience, the course plan which I have designed have the following plan, and you can see from lecture number 1, you can look at the topics which we will be covering: introduction to syllabus, paper pattern. That would be the start of the class. Then we will cover IAS 37. Provisions, contingent liability and contingent asset. Along with that, we have asset held for sale, IFRS 5, held for sale and discontinued operations, and borrowing cost, IAS 23. Then the second lecture will be on IAS 16, property, plant and equipment, investment property, IAS 40, government grant, IAS 20, IAS 38, intangible assets, and impairment, IAS 36, plus the ethics, topic of the ethics. We will be covering here. Then lecture number 3, we will be covering accounting policy, standard IAS 8, events after reporting, balance sheet, date, IAS 10, segment reporting, IFRS 8, and related party transaction, IAS 24, and fair value measurement, IFRS 13. And lecture number 4 will be on IFRS 15 revenue. So these are the plan of first 4 lectures, but it can be 5 or 6. It can be 5 or 6. But as the plan, we will try to complete these topics in a 4 lecture, and these are the topics which are not new for us. These are the topics which we have covered these topic in FR level as well. These are all the topics which we have covered previously. We would be revising these topics in SBR, but these are still very important topics. These are, if I would say, these are the favorite area. The first 4 lectures are the favorite area of your examiner to give question or to give case studies. Okay, so that will be the plan of first 4 lectures. Then we will having a test 1. After that, we will covering IAS 19. It is employee benefits. IFRS 2, which is about share-based payment. IFRS 16, leases, financial instrument. IFRS 9 and IAS 32, then tax IAS 12. That will be the next topics which we will be covering in the next phase. And after this topic, we will be having test number 2. Then after that, we will be revising basic groups, IFRS 3, IFRS 10, joint venture, IFRS 11, IAS 28, business combination in step acquisition and disposals, Forex, IAS 21, consolidated cash flow, and then we in the lecture number 15, we will be having other areas, alternative performance measurement, and if there is any current issue, we will be covering that issue, and the other areas of SBR we will be covering in the last lectures. So that will be the course plan which we will be following, in this exam, or the topic which we will cover in SBR exam in a strategic business reporting. Okay. You got it? Any question? Any questions, students? Okay, now we will look at the ACCA practice platform. Around when is the syllabus expected to be completed? Look, it is for June session. So I think your course would be completing in the last week of April or in the first week of April. Okay, maximum in the first week of April, May, the course would be completed. Okay, in the last week of April or in the first week of May, the course would be completed. You can see the course plan. The expected number of lectures are 15. Okay, so you can count that we would be taking 15 weeks from now. This is the first week, and after that, the 14 weeks we will be completing the lecture as per the plan. But due to some unforeseen circumstances, the number of lecture can be increased as well. Keep this thing in mind as well. But my experience is that we completed the topic in a given deadlines. Okay, so you don't worry. So now okay, this is ACCA practice platform. It will take a moment. Okay, here we have SBR specimen international. Okay, one more thing that we are covering the international scheme. We're covering international scheme for SBR. Okay, there is a UK scheme, there is a Singapore scheme, but we are having international scheme of SBR, which we are going to cover. So this is your exam screen you are looking at. Now, your section A of your exam, as I told you, you have two sections, and this is the section A of your exam. This is the first question. It is the first question. Now, if you look at the left side, if you look at the left side of your screen, you are looking at the exhibits. You are looking at the exhibits of first question. Exhibits, you can say that the exhibits are basically the parts of the question. Part of the question. Exhibit number 1, 2, 3, 4, 5, 6. We have 6 exhibits, and for exhibits we have following requirements. We have the following requirements. For example, if we first read the requirements, first requirement is we haven't studied the exam question paper yet, but we are reading the requirement first. After that, we will read the exhibit and relate the requirements. So first requirement is explain to the director. Okay, focus on the requirement. Explain to the director. In F7 level, at FR level, there is nothing like explain. That there is a prepare consolidated balance sheet, prepare financial statements, or do the ratio analysis, and or there would be OT question only. Okay, but here explain to the director of the question company with suitable workings. Explanation with the suitable workings. How goodwill should have been calculated on acquisition of house company and initial acquisition of MAC company, showing the adjustment that need to be made to the consolidated financial statement as at 31st December X6 to correct any error made by the finance director. So when we will read the question, you will find that there are some mistakes in calculation of the goodwill. So we need to explain that what are the mistakes, what is the right way to calculate the goodwill, and then we have to correct the goodwill with the suitable calculations, and we do the double entry to correct the error. We have to explain this process out, and this requirement is purely relating to group accounts. I told you that question number 1 will based on group account, and we have 10 marks. And then B requirement again, explain with the suitable working how the gain or loss on the sale of N company should have been recorded in a group financial statement. There would be an associate or subsidiary company that might have been disposed of. So we need to calculate the gain. Again, these 5 marks are again relating to group financial statement. Then C, discuss with the suitable working. You can see, explain, discuss with the suitable working how the pension scheme should be dealt with after restructuring by the K company. Okay, now this requirement is on a specific accounting standard, which is IAS 19 employee benefit. Okay, group account plus specific accounting issue. And then we have to advise the Pekuchen company that what is the difference between equity and liability. Okay, and what would be the treatment of contingent payment of subsequent acquisition of 20% of the MAC company. Okay, so again, if you look at the requirement, explain, discuss, advise, group accounts and some issues, accounting issue in this question you can see in the requirement. So these are the requirements. And after the requirement, you have response option. You can see at your left side, these are response option. As per the requirement, we will respond the answer using word processor, where we have to explain, discuss. We would be explaining and discussing here, and the relevant part calculation we would be performing on a spreadsheet. If we are calculating the correct goodwill, that goodwill we would have been calculated using a spreadsheet, and we will give a reference. Okay, this is the calculation of the first requirement of the question. This is the answer of the second requirement of the question calculation. And when we will explaining there, we also giving the reference that this is the explanation of the first requirement. This is the discussion or explanation of the second requirement. And in that discussion, we would be using the calculations which we have done in a spreadsheet level. Okay, so requirement and response option. Now, exhibits, role of the exhibit. Now, when you click the first exhibit, the question paper is open. The relevant part of the question paper. You can see, you can say that it is the first page of your question paper. This exhibit number 1, first page of your question, or first paragraph or second of your question. Okay, you can say to explain that what are the exhibit. So when you will read it, there will be detail given that on 1st June exchange 6, Cushion Company acquired 70% equity interest of House Company. The purchase consideration comprised of 20 shares of $1 of Cushion Company at acquisition date, and further 5 million share on 31st December X7. If House Company net profit after taxation was at least 4 million. Okay, share exchange and contingent consideration. The market price of the Cushion Company share on the date of acquisition is given, and the detail of the House Company and the other details would be given here. So you will read the exhibit 1, then exhibit number 2. When you click the exhibit number 2, the next page of the question paper, next page of the question 1 will open, and in that the information would be given, and so on. Exhibit number 3, exhibit number 4, 5, and 6. So when you will, obviously you will complete the reading of exhibit first. Okay, then after reading the question 1, when you have read all the exhibit and you have requirement in your mind, so you can your mind start to work. Okay, if in a exhibit number 2, the exhibit number 2 is relating to requirement number B, exhibit number 3 is relating to requirement number C and D, and so on. And after analyzing that, you can choose your response option to answer the question. So it is the question paper. First, we have question paper in a physical format. Now in a computer-based environment, we have in an electronic format, which is known as exhibit. So once you have completed this question, and now you move to question number 2, you will click the next, and again the same structure. The question number 2, requirements are 20, and there is only one response option in this question. In this paper, question number 2, the response option is only one for question number 2, which is word processor. That means in this question there is no requirement. There would be no requirement of calculation, and you can see 18 marks requirement. Discuss the ethical and accounting implication of the director's suggestion from the perspective of reporting accountant. 18 marks. And when you will click the exhibit, again you start to read the questions, information, exhibit number 2 and exhibit number 3. And again, when you have completed the reading of the question and you have read the requirement, you will use the response option to type your answer. And after that, the section A1 is completed. You have the section B. Again, you can see the same structure: exhibit, requirements, and in this question, again, we have only one response option to answer the question, that is word processor. That means in this question also, there would be little calculation would be involved. As you can see, read the requirement: advise the African company on appropriate accounting treatment, its vehicle and its land with reference to the relevant international financial reporting standards. Vehicle, land, 8-7 marks, and B, discuss the impact which mixed the measurement approach may have on the analysis of the financial statement by the investor. So after reading the exhibit, connecting these with the requirement, you will start to write answer using the word processor. And after that, you have a question number 4. And in question number 4, again, exhibit. There is only one exhibit. Only one exhibit. Question is given. Then you have requirements, and you have 3 to 4 requirement of this question. And again, in this question, you have 2 response options: word processor and spreadsheet. Okay, and we will use the relevant response option, that whether the calculation are involved or the discussions are involved. Okay, but keep one thing, let me clarify one thing, that for one requirement, we can use the both response option. As in this question, we have 2 response options: word processor and spreadsheet. So if I'm answering the requirement A, to answer the requirement A, I can use both response option, word processor and spreadsheet. The calculation part will be done on spreadsheet, and discussion part will be done using the word processor, Got it? So that will be your question. And let me tell you one thing. I don't know how much, to what extent that thing is true, but there are rumors that if you have clicked the flag for review, that you have attempted the question and you are attempting the other question, and you want to flag the specific question, and if you don't unflag at the end, the examiner would not would not check the question which you have flagged. In my opinion, it is a wrong information, but on the safe side, keep this thing in mind, that if during the exam you have flagged, if you have done a flag any question, just on a safe side, just remember that you should unflag that question at the end. Okay, so there would not be any ambiguity. Okay, so it was your you can say the exam pattern, exam platform, or the exam screen on which you would be giving your exam, computer-based exam of SBR. And if you have any question on that, you can ask me. Any questions, students? Any question relating to course plan, exam pattern, or the exam platform you want to ask? Okay. Now, the final thing of the introduction, the study material which we are going to use. This time I'm using the Kaplan study text and Kaplan exam kit. Okay, they are very comprehensive, and they are very, you can say, very well written, and that would be very helpful for the student to pass their exam. Okay, so we would be using Kaplan exam kit and Kaplan study text for the reading, for your reading at your home. When you want to revise the topic, you can revise the topic from the Kaplan, and we will doing practice using the Kaplan practice exam kit. And the latest book and exam kit have been shared with the management, and they will share the resource with you. Okay, and we will be using that resource for SBR preparation. So as per the plan, we have done the introduction, paper pattern. Now we will start the topics. And in this class, we will be covering IAS 37 provisions, contingent liability and contingent asset, IFRS 5, asset held for sale, and the borrowing cost IAS 23. Provisions, contingent liabilities, and contingent asset. IAS 37. So this is the first standard which we are going to revise in SBR. And again, this is the topic which we have studied at FR. So that is the same topic. We will revise this topic first, and then we will go for the practice questions. And there is only one difference in SBR and in FR, between FR of this relating to this topic, is that the way the question will be asked, that would be different. Okay. So provisions, contingent liability, and contingent asset. So in this standard, we have three things. First of all, provision. Can anyone tell me that what mean by the provision? What is provision? Provisions. What is the definition of provision? Okay. Nobody has idea? Provision is a liability. What's the definition? That provision is a liability. Provision is a liability. Is a liability of uncertain time or amount. Okay. Provision is a liability of uncertain time or amount. So it is a liability. Liability means that there is a present obligation. There is a present obligation. You have to fulfill your obligation, but but at what time there will be an outflow of economic benefit, or what would be the exact amount which would be involved to settle that liability, that is not certain, that is uncertain. Such liabilities are known as provision. So if we want to understand the provision, first of all, then we have to understand the liability. That what is liability? Liability is a present obligation. Liability is a present obligation. I'm coloring that word, present obligation. Present obligation means that there is no alternative. We have to fulfill our obligation. That is the meaning of present obligation. We have to fulfill the obligation. Now that present obligation may be legal. It could be a legal obligation, or it may be a constructive obligation. It could be a legal or constructive. Legal means the obligation by the act of law, by statute, or by the court, okay, by the court order, that is legal. A breach of contract, that is legal obligation. And constructive obligation means that there is no specific legal clause, there is no specific legal clause, legal requirement, but entity own practices create expectation in the other party that the entity will fulfill its obligation. That is known as constructive. For example, if company claims that it is a very eco-friendly company and they take care of the environment in which they operate, so every stakeholder would expect that if the company is building a new factory, they will take care for the ecosystem, for the environment, for the greenery of the surrounding. So it maybe it is not required by the law, but it will become their constructive obligation. And for IAS 37, it doesn't matter that whether it is a legal or constructive. If it is a obligation, it is a present obligation, that is enough. So is a present obligation due to past event and will involve outflow of economic benefits. Okay, so that it is the definition of a liability, and the provision is a liability. So that means for a provision, there must be a present obligation. There must be a present obligation. That is a prerequisite. And that present obligation obviously due to a past event. For every obligation, there must be a past event. Without past event, there can't be any obligation. Okay. So there will be a present obligation due to past event, and as a result, there will be an outflow of economic benefit. And that is the definition of liability, and provision is a liability. So the provision should also fulfill the definition of the liability as well, if we want to record a provision. Now, if we take the examples, of the provision, the first example is warranty cost. When entity sold a product with a warranty, they are basically taking an obligation that if the product sold have any defect, they will repair the product without any cost. It is a provision. It is a present obligation on a company that if the sold product returned due to any defect, the company will repair that product without any cost, without any consideration, without any fee. So they are making a promise. So it is a present obligation. but which product will return, and how many product will return, and when they will return, and how much economic benefit outflow would involve, that is not certain, that is uncertain. But it is confirmed that some product will return, and we have made a promise that if the products are returned, we will rectify the error and return the product to the customer. So we will record a provision. So the warranty is an example of a provision, and the provision, you know, is a liability of uncertain time or amount. Similarly, dismantling cost. Dismantling cost is also an example of provision. Now, what is dismantling? Dismantling cost means that when we construct an asset, there is an obligation on us that when we complete the operation, we will dismantle the asset, and we will, you can say, we will restore the environment, restore the area in that surrounding where we have construct the asset. So that is known as dismantling cost. So we will need to record a provision because we have installed the asset. So there is an obligation on us that whenever we will go, we will dismantle the asset. Another example, if I can give you, is an example of onerous contracts or onerous contract. Onerous contract means a loss making contract. For that contract, we will also recognize a provision. Now, for example, if I give an example, I have signed a contract and I agree a fee of $5,000. I agreed a fee of $5,000. But when I determine the cost to fulfill the contract, the cost expected to be 6,000. So that means if I fulfill the contract, there will be an expected loss. There is an expected loss of 1,000. So the contract become onerous with 1,000 because it is expected that the contract would result in loss. So we will record a provision because we have signed a contract. Signing off a contract mean it is our legal obligation. It is our legal obligation that we should complete the contract. We have signed the contract, so there is a legal obligation on us, and we have to fulfill the contract at 6,000. So it is expected that there will be a loss. So on onerous contract, we will recognize the provision. Okay, so these are some examples of the where we usually recognize the provisions. Okay. Now, recognition. When a provision should be recognized? A provision will be recognized if there is a present obligation due to past event. Number 2, outflow of economic benefit is probable. And number 3, reliable estimate of cost can be made. Cost mean to fulfill the provision, to fulfill the present obligation. If these three conditions are there, can be proved, then we can recognize a provision. Means we can debit we will debit the expense or property, plant and equipment and credit the provision. Usually the provisions are expense out in a profit and loss account, but in some specific cases, provisions can also recognize in the cost of the asset. Example is dismantling cost. Example is dismantling cost. Example is dismantling cost. If there is a dismantling cost, you know that dismantling cost is recognized as the part of the cost of the property, plant and equipment at present value. Okay, usually they expense out, but they can also capitalize if they are directly, if they can be described as a directly attributable cost of the asset. Measurement of the provision. Provision should be a best estimate. When we measure the provision, it should be a best estimate if time value of money is material, then it should be discounted using pre-tax rate of return. Pre-tax rate of return. Okay. Best estimate mean that when we are measuring the provision, all the relevant factors must be considered in estimating the provision. All the expected outcomes should be considered in measuring the provision. And the time value for money material is mean if the provision is going to be settled after 1 year or more than 1 year, then the time value for money would be material, and we need to discount the provision to present value. We need to discount the provision to the present value, and to discount that provision to the present value, we will be using the pre-tax rate of return of the company. Pre-tax rate of return of the company will be using, not post-tax. Post-tax means after tax. We would be using pre-tax rate of return to discount the provision. Further, the measurement of the provision is also dependent that the provision involve single outcome or provision involve large population. That would also very important. Single outcome mean, let's say we are talking about a court case. We are talking about a court case. Court case would be a single outcome, that whether it's going to be in your favor or against you. So court case is an example of single outcome. If the provision involve the single outcome, then most likely outcome would be considered in measuring the provision. In measuring the provision, the most likely outcome would be considered. Now, most likely, what mean by the most likely outcome? Most likely outcome means, for example, your lawyer told you that there is 60% chance that fine would be $50,000 and 40% chance that the fine would be $10,000. So 60% is the most likely. So 60% chance that the fine would be $50,000. So we will record a provision. So we will record a provision at $60,000. We would record the provision at $60,000. Okay, most likely outcome. And large population, if we are making a provision of large population, the warranty cost is an example where we can say a large population is involved. Means more than one outcome are possible because number of products are involved. In that case, the expected value method will be used. Expected value method will be used to measure the provision. We will use the expected value method. Average probability based method will be used to measure the provision. Just let me give you an examples, numeric examples. From topic. So when you will get the notes, we are at the moment chapter number 11, provisions, contingent liability and contingent asset, page number 233. So provisions, and it is about the measurement. Now look at, test your understanding too. Warranty. Please read it. Test your understanding number 2. So clean sell domestic applicants sell appliances such as washing machine. On 31st December X1, the clean decides to start selling washing machine with a warranty. Under the terms of the warranty, clean will repair the washing machine at no charge to customer if they break within the warranty period. The entity estimates based on the past correspondence with the customer that 20% of the washing machines sold require repair within a warranty period at an average cost to clean of $50 per machine. $50 per machine. And clean sold 200 washing machines on 31st December 20x1. We sold 200 washing machines on 31st December 20x1. So that means out of 100%, 20% machine would require repair cost and 80% machine would require no repair cost. So if we calculate the value of the provision, that would based on expected value method. They have sold yes, they have sold 200 washing machines. 200 washing machines. So basically we are saying that out of 200 washing machines, 80% machines would require no repair. So the zero cost would involve. So their repair cost would be zero. But out of 200 machines, 20% of the machine would require a repair. And each machine will cost $50 for repair cost. So $2,000 cost would be involved. So the value of the provision, which we are going to recognize on expected value method, is $2,000. You got it? Please read this part as well, conceptual framework. Please read it. The provisions are the liabilities where the amount required to settle them or the timing of settlement is uncertain. To be useful, financial information must be relevant and must offer faithful representation of underlying transaction. The measurement of the provision require estimation, and this increase the risk of manipulation and error. The provision measurement and the recognition of provision is a matter of judgment, is a matter of it is a subjective measure, is a subjective matter. So in this case, there is a chance that the accountant may manipulate the financial statement, and the financial statement may result may compromise reliability or the relevance of the financial statement. So when an accountant is involved in measuring and in recognizing the provision, they must adhere, they must remember that they are bounded by the ACCA Code of Ethics. Means they must use objectivity, they must work with integrity, but they must use their professional competence and due care, confidentiality. They must adhere these principles when measuring and recognizing the provision. And to ensure that provision are faithfully represented, IAS 37 has extensive disclosure requirement. Prepare financial statement are required to outline the estimation technique used and uncertainties relating to the amount or timing of the eventual payment. Okay, so these are the some guidelines which the accountant must adhere to follow the code of ethics of the ACCA. And this point is relevant for the question number 2. We will look at the practice question where there are a number of case studies given in the past papers that there is a situation where the accountants are recognizing provision. There is a discussion that provision should be recognized or not. Okay, and the recognition of the provision may affect their bonuses or their personal perks, financial benefits relating to their jobs. Okay, so in those situations, this guideline would be very important for you. So that was the about the provision. Now, contingent liabilities. What are contingent liabilities? What mean by the contingent liability, students? Anyone? Contingent liabilities or contingent liability. Contingent liability is a possible obligation due to past event. Number one, contingent liability is a possible obligation, not present obligation. For example, there is a claim on you by the customer that you must compensate you, that the company must compensate the customer, but the matter is in court, and your lawyer told you that there is a 50% chance that you may lose the case and 50% chance that you may win the case. So it is a stage of possible. It is not a present obligation, it is a possible obligation. So contingent liability is a possible obligation, and it is due to past event. Number two, or contingent liability is a present obligation but outflow of economic benefit is not probable. Or a reliable estimate cannot be made. That would be the contingent liability. That is the definition of the contingent liability. And you know that contingent liability is only disclosed. We only disclose the contingent liability in financial statements. And the contingent asset, what is contingent asset? A contingent asset is a possible asset. Contingent asset is a possible asset which may result in your favor in the future. And contingent asset is also disclosed in a financial statement. We do not recognize the contingent asset in a financial statement as well. We only disclose it. And it is chapter number 11, which we are doing at the moment. IAS 37, provisions, contingent liability, and contingent asset. Now, some specific situations, future operating losses. Dear students, just remember that provision cannot, we do not recognize a provision for future operating losses, because future operating losses, in future operating losses, the event will be in the future. There is no past event. Okay. And if a business is making losses, there is no obligation that we should run the business. We can shut down the business. Okay. So there is no obligation, there is no past event. So future operating losses, we do not recognize any provision. Similarly, for staff training costs, for the purchase of the asset, we also do not recognize any provision, because 37 strictly prohibit to recognize the provision for future operating losses. Onerous contract, we discussed the onerous contract, and for onerous contract, you know that we recognize the provision. Okay, we discussed this earlier. Future repair to asset, for repair of the asset, we also do not recognize any cost. For overhauling, repairing, marketing cost, or to purchase the asset, we do not recognize any provision. Now, read the understanding number 3. Read test your understanding 3. Danboy, a company that owns several shops, has year end of 31st December X1. One of the shop is loss making at 31st December X1. Danboy forecast that the shop will make a loss of $50,000 in a year ended 31st December 20X2. As at 31st December X1, one of the shop building require repair. The cost has been estimated that at the reporting date is $10,000. The repair is made in a following accounting period at the cost of $12,000. The requirement is discuss the accounting treatment of the above in a financial statement for the year ended 31st December X1. Dear student, first of all, the future operating losses, IAS 37 is very clear. IAS 37 is very clear that no provision can be recognized. No provision can be recognized for future operating losses. So for $50,000, we will not recognize any provision in 31st December X1. Similarly, for the future repair or repair and maintenance cost, we also do not recognize any provision. So no provision of repair and maintenance equivalent to $10,000 will be made in 20X1. Rather than when we have incurred actual repair and maintenance cost of $12,000 in X2, it will directly expense out in a profit and loss account. Expense will be debited, bank would be credited. That would be the appropriate treatment. Now read the understanding number 4. Under the new legislation, the entity is required to fit smoke filters to its factory by December X7. At the reporting date of 30th June X7, the entity has not fitted the smoke filter. He has told me, should we recognize a provision to install smoke filters? Yes or no? Yes, student, should we recognize a provision for smoke filters? For recognizing a provision, there should be a present obligation due to past event. Do you think that there is a present obligation that we should install smoke filters? I need your answer. No, there is no obligation. Yes, government requires us that we should install the smoke filters, but we have alternatives. We can choose to pay fine. We can choose to pay fine rather than installing costly smoke filters. Or even we can consider to shut down the business rather than installing smoke filters. So we have alternatives. So there is no present obligation on us. So for smoke filter, we will not recognize any provision. We are not going to recognize any provision. You got it? Can you hear me? Environmental provision is an example of site restoration cost or dismantling cost, or we recognize these provision at present value. We recognize these provision as present value, as you know, and on initial stages it can be recognized as the part of the cost of the asset, but subsequently the unwinding of these provisions are expense out in profit and loss account. Now, understanding number 5, environmental provisions. We have 2 case studies here. An entity has a policy of only carrying out work to rectify damages caused to environment when it is required to do so by local law. For several years, the entity has been operating in overseas oil rig which cause environmental damage. The country in which the oil rig located has no legislation in place that required this damage to be rectified. A new government has recently been elected in a country at the reporting date. It is virtually certain that the legislation will be enacted that will require damage rectification. This legislation will have retrospective effect. So what do you think? In the first case study A, what do you think? That entity should recognize a provision for environmental damages on the basis that the new government, it is virtually certain that the new government will pass the legislation in which they require to rectify the damage retrospectively with the retrospective effect. What do you think? Yes or no? Again, keep in mind the provision is recognized when there is present obligation due to past event. So in this case, there is a past event. They have caused a damage to the environment, and it is virtually certain that the legislation will be passed, the law will be made. So it has become the present obligation. So a provision should be recognized. So provision should be recognized in this case. Second case study. Under a license granted by a local government, an entity has constructed a rock crushing plant to process material mined from the surrounding area. So local government has given a license. They will crush. They have a rock crushing plant they have installed in which they will crush the rock which they have mined. Mining activities have already started. Under terms of the license, the entity must remove the rock crushing plant when mining activities have been completed and must landscape the mined area so as to create the national park. So it is required by the law. It is required by the local government. So it is a present obligation. It will involve the cost, and there is a past event because the crushing is already started, mining is already started. So a provision should be recognized. So the provision should be recognized in this case. So the statutory understanding number 6. On 1st January X6, Scrubber spent $5 million in erecting infrastructure machinery near to an area of natural beauty. These assets will be used over the next 3 years. Scrubber is well known for its environment-friendly behavior and is therefore expected to restore the site after its use. So it is their constructive obligation. The estimated cost of removing the asset and cleaning up the area on 1st January X9 after 3 years would be 3 million. And pre-tax rate of return is 10%, and Scrubber reporting year end is 31st December. So how should this transaction should be accounted for in a financial statement? Now look at the Excel sheet. First of all, on 1st Jan X6, plant cost, the value at which they have installed the asset is 5 million. So we will take the 5 million. and provision of cleaning or dismantling will be recognized as the part of the cost of the asset, but it will be recognized at present value. So after 3 years, it will involve a cost of 3 million, and the discount rate is 10%. So 1.1 raised to power minus 3. The present value is 2.25. Yes, 2.25 is the present value. So the total cost of the asset will be 7.3 on 1st January 20x6, and 2.3 will be recognized by debiting the asset and crediting a provision. And then on year end, on 31st December x6 at the year end, the plant carrying value will be equal to 7.3 minus depreciation, 7.3 divided by 3. Whole year depreciation will be deducted, and the value of the carrying value of the asset will be 4.9 at the end of the year one, or approximately 5 million. And the value of the provision will be equal to 2.3 plus 2.3 multiplied by 10%. So it will become 2.5. That will be the value of the provision at the end of the year one. And these are the values in statement of financial position. And if we talk about profit and loss account, there will be only depreciation 7.3 divided by 3 years. So 2.4 or 2.4 will be the depreciation expense. It is depreciation expense for the year. And finance cost at the end of the year one will be 2.3 multiplied by 10%. So that will be the finance cost, and it will be recognized in a profit and loss account. So that would be the accounting treatment of the provision in a financial year. So initially the provision is recognized at present value, provision is credited, and property, plant and equipment is debited with 2.3. Then the asset will be depreciated 7.3 divided by 3. So that will be the depreciation, and 4.9 would be the carrying value at the end of the year one. And at the end of the year one, the provision will be unwinded. And for unwinding, we will take the opening value of the provision multiplied by the rate of return, which is 10%. So 0.3 is the finance cost. The finance cost is debited and provision is credited. So at the first year end, the value of the provision will be 2.5. Round figure will be 2.5. You got it? The last topic of IAS 37, restructuring. Dear student, restructuring is a program controlled by the management in which the manner of doing business or the scope of the business is changed. Scope of the business mean we may have close our factory, or we have withdraw from the geographical area. In that case, we have to redundant number of employees. Our manner of doing business is changed from a manual system, we move to automatic system. So that is known as restructuring. And whenever there is a restructuring, the people will be fired from the job. People would be fired from the job. Okay. And when the people will be terminated, we will have to give them some benefits. For example, redundancy cost, we have to given them by law. Okay. When we terminate the employee before the completion of their job. So that provision is known as restructuring provision. And the examples of where the restructuring could may result in, for example, closure or sale of a line of a business, the closure of business location in a country, the relocation of business activities from one country to another. These are the example of the restructuring. Now, when the provision for restructuring will be made, just remember two conditions, and following are the two conditions. If these two conditions are fulfilled, provision for restructuring will be recognized. Number one, there should be a formal detailed plan relating to restructuring. Identify the business location, the number of employees who are going to affect. And number two, those employees who are going to be affected are communicated, or the plan has been started to implement before the year end. If these conditions are done, then a provision for restructuring will be made. Detailed formal plan should be there before the year end, and either the plan has been communicated or it has been started to implement it. Then we will recognize the provision for restructuring. Otherwise, provision for restructuring will not be made. Look at the understanding 7. On 15 January X5, the board of directors of the Shen voted to proceed with two reorganization scheme involving closure 2 factories. Shan reporting date is 31st March and the financial statement will be authorized on 30th June. Scheme 1, the closure cost will amount 125. The closure will be announced in June and will commence in August. So the announcement will be done after the year end. So for scheme 1, no provision will be made on 31st March X5 because the announcement will be done on June after the year end. Scheme number 2, the cost will amount 45,000 after crediting 105 profit on disposal of the certain machine. The closure will take place in July, but redundancy negotiations began with the staff in March. So in this case, formal plan is available, and if the negotiations are started before the year end, before the March, that means the plan has been communicated. If this is the case, for scheme 2, a restructuring provision can be made. Okay, you got it? Yes, students. Okay, so it was the IAS 37. And this was the topic of F7 as well. So we just revised the main points. And when we will do the practice question, obviously we cover the IAS 37 in the practice as well, because it is a very favorite area of examiner. Examiner frequently asks the question from this area. So the standard has been completed. We have revised the IAS 37. Now we will move to the other topic of the day, which is IFRS 5, asset held for sale and discontinued operation. But first, now we will take a break of 15 minutes. And after the break, we will resume the class. Okay. And this is chapter number 11. And this is chapter number 11 of IAS 37, which we have done. When you get the book, kindly revise the topic from this chapter. Now we will take a break of 15 minutes. Okay, students, welcome back. Now, the topic we are going to discuss is IFRS 5, non-current asset held for sale and discontinued operations. This is the topic we are discussing now. Asset held for sale, first of all. Asset held for sale means those non-current assets about which we have taken a decision that we will no more use. We are not going to use those assets anymore. Rather than using those assets, now we have decided that we will dispose or we will sell such assets. So such group of assets is known as non-current asset held for sale. IFRS 5 defines that those non-current assets whose recoverable amount is will derive from fair value less cost to sell rather than value in use. Or we can say such non-current asset whose value in use is zero and the recoverable amount is totally dependent on fair value less cost to sell. Such assets are known as asset held for sale. Asset held for sale. And number two, the IFRS 5 discuss these discontinued operations. Discontinued operations. Now, what is discontinued operation? Discontinued operations are basically the component of entity, component of the entity, you can say a cash generating unit of the entity, which has been sold, the component of the entity which has been sold or classified as held for sale. And that component of the entity represents a separate business line. Separate business line mean separate production line or a separate geographical area. For example, for an Pepsi International, the beverages is a different product line, and the Lay's, their product, is a different product line. For Coca-Cola International, Africa is a different geographical location and the South Asia is a different geographical location. Okay, so the component entity either representing a product line or geographical area, or is a part of plan to dispose of a separate line of a business or a location, or it is a subsidiary which is acquired with the view of resale, with the purpose to resale. Such component of the entities are known as discontinued operation. Discontinued operation. Now, for discontinued operation, the requirement is very simple. The profitability of the discontinued operation should be disclosed separately in profit and loss account. Their profitability and other comprehensive income should be shown separately from the continued operations. Okay, for discontinued operation. But for held for sale asset, the asset which are classified as held for sale, they should be presented below the current assets. The asset held for sale should be presented below the current assets with the separate heading of held for sale in a statement of financial position. The assets which are classified as held for sale, they will no more depreciated. We will not depreciate such assets which are classified as held for sale. Number three, the held for sale asset will be measured at the lower of carrying value or fair value less cost to sell. Carrying value or fair value less cost to sell. So held for sale will be presented below the current asset. Held for sale will not be depreciated, and held for sale will be measured at the lower of fair value less cost to sell or carrying value. That would be the presentation and the measurement of the non-current asset held for sale. But to classify an asset or an operation as an held for sale asset or held for sale operation, there are some conditions which must be fulfilled in order to classify an asset or a component of the entity as held for sale. Number one, the asset or the operation should be available for sale immediately. Available for sale immediately. Available for sale immediately means that there is no condition attached. For example, the company decided that they will dispose of their plant and machinery, but they are still using that plant and machinery for manufacturing purposes. And they're still accepting the orders of the product which will be produced using that particular plant and machinery. That means that asset is not available for sale immediately. Okay, so first of all, the condition is that asset should be available for sale immediately. And number two, the sale must be highly probable. Sale must be highly probable. Highly probable means it should be completed within a year. Management is committed to sale. The operation is actively marketed. The sale price is reasonable, fair value, and it is unlikely that the plan will be withdrawn. If these conditions are fulfilled, then we classify an operation or an asset as held for sale. A presentation, as I told you, that for discontinued operation, the profitability of the discontinued operation should be presented separately from the continued operation in a profit and loss account. And why it should be shown separately, so the user can see that which profit will not be available in the future. The profit which are relating to, or loss which is relating to discontinued operations. Here you can see the explanation that we have revenue, operating expenses, profit from operation, finance cost, profit before tax, and profit for the year is 14 million, and it is from continued operation. And discontinued profit and loss is presented separately, in a profit and loss account. And why it is important? For that investor perspective is very important. Look, the shareholder is the most important stakeholder of the company, and they are the main investor of the company. So if I am an investor, if I do not present the discontinued operation results separately and I just shown the 11 million loss, then how investor will feel confident? Okay, this year we have a loss of 11 million, but the next year the 25 loss would not be part of the financial statement. We will be in the profits. So that's why, to make them easy, to make them communicate that the discontinued operation would not be available, and in future the discontinued operation would not affect the profitability of the company. That's why it is necessary that the operations of the profitability of the discontinued operation should be shown separately in a profit and loss account. Okay, you got it? Now, please read the understanding number 2. Please read the understanding 2. The Portugal group of companies has a financial year end of 30th June to X4. The financial statement were authorized 3 months later. That means year end is 30th June, then July, August, September. At the end of the September, they will be authorized. The group is disposing of many of its subsidiaries, each of which is separate major line of a business or geographical area. A subsidiary England was sold on 1st January X4. So the subsidiary which has been sold England, a subsidiary England which has been disposed of on 1st January X4, that is a discontinued operation. Okay, because that is representing a separate geographical line of the business. England is a separate geographical area. So it will be a discontinued operation, because that has been disposed of in the current year. So it is a discontinued operation. Number two, on 1st January X4, an announcement was made that there were advanced negotiations to sell subsidiary in Switzerland and subject to regulatory approval. This was expected to be completed by 31st October X4. Now, this is not a discontinued operation because it is not available for sale immediately, because there is negotiations going on advanced level, but it is subject to regulatory approval. That means unless we get a regulatory approval, the subsidiary cannot be sold. So it is not available for immediate sale. So it cannot be presented or classified as discontinued operation, because it cannot be classified as held for sale. Number three, the board has also decided to sell a subsidiary called France. Agent have been appointed to find a suitable buyer, but not have yet emerged. The agent advice is that potential buyers are determined by the expected price that Portugal hope to achieve. That means they have marketed the company more than reasonable fair value, more than reasonable fair value. They have marketed the company more than reasonable fair value, and it is a condition that it should be marketed at a reasonable fair value. So the fair value, the price they have asking, is a hurdle in disposing of a subsidiary. So again, it cannot be classified as held for sale or discontinued operations. Number four, on 10th July X4, after the year end, an announcement was made that another subsidiary, Croatia, was for sale, and it was sold on 10th September. So it was okay, that was sold on 10th July. The year end is 30th June. So it is happening after the year end. So the event is taking place after the year end, condition exists after the year end. So at the year end 30th June X4, it cannot be classified as a discontinued operation. You got it? Yes, students. Any question? Okay, any questions, students? Can you hear me? Okay, students. We have an introduction class today. We take the revision of IAS 37, and we look at the IFRS 5 asset held for sale and discontinued operation as the topic of asset held for sale and discontinued operation. I think it is enough. Now in the next class, we will be doing first of all IAS 23 borrowing cost, and then we will doing a practice question from past papers relating to these topics, and then we will continue the topics of the lecture number 2. Okay, so this is end from my side. This is the end of my side. If you have any question, you can ask me, and if you want to share any feedback, you can also share the feedback. The fee of the course, I have no idea what is the fee, because it is the management which will tell you. So for that purpose, I would recommend that you should contact with Mr. Hamzah or the coordinator of Mr. Hamzah. He can guide you. Okay. Um, I have no idea that what is the fee for the course. Okay. Anything from your side? Any feedback you want to share? Okay. Okay, students. Thank you very much. Uh, Goodbye and take care. Uh, See you next week. I hope that we will be having another class in the next week. So goodbye and take care.